Hi, I'm Kenny Klaus, and this is State 48 Homeowner.
Well, guys, we've had a very interesting market, especially in finance, over the last couple weeks. So let's dive in. Steve, let's start talking. The big thing that's out there, let's talk about Silicon Valley Bank.
Let's talk about Silicon Valley Bank, huh? Well, needless to say, it wasn't a sudden thing. I mean, it happened over several weeks. Mm-hmm. But I
think just publicly, it was more of a sudden thing.
Sure. I mean, it's not necessarily a household name. I mean, Silicon Valley Bank was the 16th largest bank in terms of assets and the second biggest bank failure on record. Second to WAMU. Back in 2008, 2009. But
keep in mind too, 90% of their depositors were over the $250,000 limit. So this wasn't mom and pop.
Well, no, Silicon Valley Bank, to really draw the business, I mean, venture capitalists, tech startups, so already a very volatile client base on a large portion of it. But also Silicon Valley Bank, they take a lot of those assets, and when you buy treasuries at high prices at low yields, and then you've got to sell them in a higher yield, low price treasury market, or mortgage-backed securities, bonds, things of that nature, you're now taking losses on those assets, and that's what caused that, and then it just exacerbated and then just continued to roll. So already a volatile client base followed by a volatile and turbulent time in selling assets. Just
it was really poor management too. It sounded like they were kind of asleep at the wheel in terms of that, from what I've been reading and things.
Well, when you don't have a chief risk management officer for 8 months, so from April of 2022 to January of 2023, they didn't have their chief risk manager. She left the company last spring in 2022. So in a volatile time where somebody would hedge these types of losses or, get ahead of it, they didn't have anybody in place to do that. Not to pick on anybody, but, they also had their chief admin officer was the former CFO of Lehman Brothers. And we all know what happened to Lehman Brothers. So again, not pointing fingers, but very mismanaged bank, in my opinion and opinion of others, that just saw a huge run on their deposits.
Yeah, word got out, and
they
were trying to raise money, and
that's a big thing too. Is not only just social, but just some of the VC capitalists just kind of getting on the phone and saying, "Hey, pull your stuff, pull your stuff."
Well, and people have to realize too is that if you deposit $100,000 in a bank or $10,000, use $100,000 because the math's easier. The bank doesn't have your $100,000 sitting in the vault like they do in all those great heist movies that are out there. They've got usually about 10%. And then the rest of it they invest, and then that's how banks make money. So again, when people make their call, the venture capitalists now, they're like, well, hey man, I want my 100,000 out. The bank has to sell assets to get that, and there's a run. They've got to sell more and more, and it's a snowball effect. It's unfortunate, but
it appears to be kind of isolated.
It is. I mean, there was another bank, Signature Bank, that failed as well. And again, it's that run. It's that run on regional banks. So what we saw on the following, because that happened on a Friday, and then over the weekend it failed. FDIC comes in. They kind of halt everything, and then they will auction it off. And so a bank will probably come in and buy the assets. I actually worked for a bank that went through this back in 2009, so I'm very familiar with the process. The men in black come in with their dollies and forklifts and haul everything away. But, I mean, pretty isolated. And then, of course, knowing that there'd be a run, the Fed, the FDIC, and the Treasury all stepped in with a non-taxpayer funded plan to kind of calm the markets, back the depositors, in some cases above that $250,000 FDIC insurable limit. So again, knowing that run can happen, and then again, on that Monday, you saw that initial run, people pulling deposits out of certain regional banks, and then the following day, markets have calmed and those stocks are back up, and everything seems to be business as usual. So hopefully it's a very isolated incident, which it should be. due to mismanagement, terms in the
bad
market,
bad investments,
and again, very high risk. You're talking tech startup.
And tech's and tech's had the most layoffs. I mean, they're the industry that's getting hit the hardest. So if that's their bank, I mean, it only makes sense that could happen. So, but obviously, it was a big headline. It drove a lot of people to the bond market. It sounded like for a while.
Oh yeah, I mean the mortgage-backed. I mean, unfortunately, when there's a panic in the financial markets, it's usually very good for interest rates and specifically mortgage rates, which we saw happen that day. And U.S. Treasuries did very well, mortgage rates did very well, but then the next day when everything calms down and you add in that inflation data, it kind of gives back a little bit of the gain. So here we are again playing the volatility surveys.
Where are we at about right now, you think, with rates?
High sixes.
Okay.
At high sixes on the average 30-year fixed rate. I think that you'll see some borrowers will probably get quoted in the sevens, and some lenders are in the sevens just because that's where margins are at. But some borrowers...
And just so everybody knows, we are recording this about 5 days ago.
Well, and that's okay. Yeah. I mean, it happens on a daily basis, but I mean, right now, what we're talking about on, March 14th, that's kind of where the average 30-year fixed rate is today.
And it's been interesting because, we saw this last year, right? When over the summer rates got up, high sixes, sevens. And then in August, we had that little break where they were down at, I think 5.25 at one point in August. We had a huge turn in the market for about 3 weeks in terms of sales, multiple things like that. Then they rose back up again. So when they started out, this year and got into the low sixes, even high fives for a little bit, and then we had a great run 6 weeks, and then they started to go up. But what we'll tell you is we haven't seen an impact on the market yet in terms of with rates being higher. It's not like it was when August they went from 5.5 to 6.5 in September. It has not slowed down the market at all. And again, going back to supply and demand, I mean, right now we have about 2,000 less active homes than we did beginning of January. We have about 3,000 more under contract than we did the beginning of January. Our list to sales price ratio has gone up almost a full % from January, which means homes are selling closer to where they listed at.
And we're seeing far fewer cancellations and expirations.
Right. Correct. And the listing success rate, which is very interesting. That, and so it was 62% in January. It's 78% as of Monday. So that's changed a lot. For the first time this year, our median sales price rose 2 weeks ago. It was $410 since the beginning of January. And 2 weeks ago, it went to $415. It's $417 today. So it's gone up $7,000 this year.
Yeah, when you see multiple metrics showing that uptick, we don't really like price per square foot.
No,
but that is an
indicator
that we can look at.
That's up $10 a square foot since January. And it's interesting. Like I said, we're down 5%, almost 5.5% in inventory from last month. And this is typically listing season, right? This is typically our busiest time of the year in Arizona market. If I go back pre-COVID and for the 20 years prior to that, spring break through July is typically our peak season. But, they talk about it, and it's the idea that what's keeping inventory down is the rates, because people either refied or bought in the last couple of years, and they're in the low threes or whatnot, and it's preventing them from wanting to go move and pay.
And we talked about it last month. We talked about being
more in love with your mortgage
and a self-imposed rate lock, and that's something that's real. We're seeing a lot of studies coming out that a huge chunk of the buyers this year will be first-time home buyers.
Yep.
Yes.
Primarily because of that, and some really big figures. This is a great opportunity for
if you look at if prices are stabilizing and starting to go back up again, understanding that the sooner you get in, the better, because you can always refi that rate. You cannot refi the house price and what you would end up paying for it. So that's what I think we're starting to see. And I have a good paragraph I wanted to read from the Cromford. It just says, the current pricing trend may contradict claims by various amateur pundits and their YouTube channels, but there is almost no data that supports the theory that prices are going to collapse from this point. For this to happen, we would have to have a wave of new supply creating problem for sellers. While this is always a remote possibility, there is very little foreclosure activity and low levels of mortgage delinquency. So where is the flood of homes for sale supposed to come from? And this is also important. The builders have cut back drastically on their new home permits, so we are more likely to see a shortage of homes for sale than a glut. So again, going back to supply and demand, we're reducing inventory. The number of homes under contract is going up. Prices are going to start following that trend.
Well, and if you even look at the CoreLogic home equity report for quarter 4 of 2022, I mean, home prices were still still up 7.3% year over year.
Yep.
And that's pretty significant. I mean, in year to date, they seem to be, like you said, they've stabilized. And they continue to increase incrementally, not the dramatic that we saw. Yet. And speaking of home, I mean, just when you talk about homes with any type of negative equity, that same report, only 1.4% of all U.S. homes have negative equity.
Right.
Well, and we saw a decrease in home prices and price per square foot, but then when you look at the chart and you see where the dip was at the end of December, early January, that lined up with October, November of 2021.
Right.
So it's not like we're going back huge strides.
Right.
In
our active and under contract count right now is almost identical to the 1st of July of last year. And things were starting, we were probably 6 weeks into the higher rates really taking impact and the market starting to slow. It's just different now because it's going the other way, right? We came from craziness in April and May, and then things started to change July, August, September, whatnot. Now we're coming back out of that. And like I said, I mean, this is the first time since probably March or April that the median sales price has gone up in the Valley. So that's clearly a sign that things are moving.
And rates increasing was resultant from the CPI. Let's talk about that. Back when that was crazy, look at back in June, that was 9%. It seems that,
We're talking about inflation.
Yes.
Yeah, okay.
CPI. And it looks like, what they've done has worked. We're down around 6, but like you said, not working enough. It's not dramatic enough, and more so for investors and even the Fed in some cases, because when the Fed is looking at things, and sometimes investors, they have to realize that inflationary data is lagging. Mm-hmm. Everything is lagging, and the Fed's actions.
It's only been a year since they started.
Lagging. Well, we said June.
Yeah.
June 9%. We were at a multi-decade high of inflationary rate of 9%, and the Fed has done that. The fear is that the Fed will continue to hike rates aggressively, and that's where we've seen some of these fluctuations in the early part of 2023, meaning that rates went from low 6% in January back up to a peak of over 7% for a period in February because of a stronger than expected jobs report with seasonal adjustments and all the other things that were added in there. And I believe
right
we made
before the State of the Union.
and all of those things happen. But what that causes is a fear that the Fed doesn't see a slowdown in the economy. And that's what the Fed rate hikes were meant to do. So
do you think the bank collapse will play into his thought process?
It can, because what happens with the bank failure, it's that usually a bank failure is evidence that the Fed's tough interest rate policies have broken something.
Yeah, and he said, I'm going to break some things.
And they know they were going to break some things. Mm-hmm. So now a lot of investors feel like they have to dial back their intensity. But unfortunately, there's also the fields of investors that are saying, like, okay, they knew the Fed was going to break some things, but they also know that they're not going to start dialing back until they see inflation come down dramatically to that 2% target. Now, it does take time. And to Scott's point, I mean, we were at 9%. We just had the February inflation reports, again, lagging. We get them in March for February. And inflation dropped. Overall, the headline inflation number went from 6.4% to 6%. Mm-hmm. That's great. That's lower, right?
Yeah.
Right? Yeah. I mean, do I have to call the count at Sesame Street and make sure?
One, two.
And even when you take out food and energy, which has been very volatile with everything going on, and we're in the spring season, so we've all seen that. I'm like, why did gas prices go up 50 cents in 3 weeks? I'm like, it's Arizona. Everybody's here for spring training and spring break. But again, when you even take out food and energy, it also slowed, but only by 1/10. So we went from 5.6 month over month to 5.5 in the core inflation rating for consumers. And again, it's a drop. It's lower. It's 8-month trend of continued inflation going down. But again, it's not accelerating fast enough in some investors' minds. So and the biggest component of it is just, listening to a report this morning, the biggest component of that consumer inflation data that's a huge lagging factor, usually by 12 months, is shelter cost. Mm-hmm. And we just got done talking about how expensive shelter was. And usually shelter, it makes up 43% of the CPI.
Right.
That's a huge factor.
It is.
Huge.
And when you're talking rents, owner equivalent rent, and lodging away, meaning hotels, VRBOs, Airbnb, resorts, all of those costs continue to escalate during that period. And again, I'm using hand signals like people can see me, but but as it's that roller coaster, and like I talked about, shelter's at the back. It's the back car. Everybody else wanted to get up front and scream as they went down the hill. Shelter's that lagging piece of inflation, and it's just starting to hit that crest. So again, once shelter costs start to actually show where they truly are now, and they've dropped. I mean, they've dropped.
Obviously.
Shelter costs have come down. Then we'll see true inflationary numbers, bigger chunks come out.
Right. It's difficult though, because when part of the medicine that you're giving the economy is to raise mortgage rates, and one of the key indicators of a lower inflation is decreased costs of housing.
Right.
You're
counterintuitive.
Yeah.
Welcome to my world.
Yes.
Yeah. but it is coming down. Like I said, and a lot of it has to do with rents more so, and owner equivalent rent. So meaning if I own a home and if I had to for some reason give up my home, what would be the owner equivalent of rent out there in the marketplace for my home?
Yep.
What would I pay? So. And there's other factors that play into it. Let's not all blame it on shelter costs. I mean, airline fares make up a nice chunk of consumer inflation. They've gone up 8%. Vehicle insurance plays 3% of CPI. That's gone up significantly. And apparel, clothing.
Yeah.
So a lot of it, again, services are starting to taper back, and that was in that other jobs report where we're starting to see more job losses. We're starting to see more layoffs.
Yeah, because the unemployment number rose a little bit.
So again, all of these lagging factors are now starting to come into play because we're hitting that that 8th, 9th month heading into the 12-month cycle to where you start seeing the Fed's actions take place.
Yeah.
To actually take hold. So...
and that's why there's a lot of talk about they should maybe just pause for a minute, because if it takes 9 to 12 months for rate hikes to take effect and you started a year ago,
right?
I mean, you got to slow down and give it some time.
Well, and that's exactly what the fear was, is because after the last, they kind of were hoping that the Fed in the next one will come March 21st. So probably, I think the Tuesday after we air our podcast here, the 21st or 22nd, the Fed meets and they will have a rate decision. A month ago, they thought that there was only going to be a quarter hike.
Right.
With all the things that have happened, they thought it was, now people got fear, and that's what caused rates to spike over 7%.
Last week, it was all, they're going to do a half point.
They're going to do a half point.
That's all you heard.
88%.
Yeah.
And that's the chart that you follow. And then bank failure. And then even with the CPI data, now it's an 83% chance that they're going to go back to a quarter.
Right.
So that's how quickly and volatile things have changing. So again, just if you can afford the home at today's current interest rates, because like you said, prices aren't going backwards.
Nowhere.
Rates will eventually come down.
Correct.
As soon as all these lagging factors that we continue to talk about take hold, they'll come down and they'll start dropping more significantly as we head into the later months of 2023. So I firmly believe that.
Would you lock a buyer now, or if they were still looking?
If they were still looking, no. Okay. I wouldn't lock a buyer. For me, I always like a 30-day window. I said, once you have a home and you're comfortable with the payment and the rate that you have, unless I see something significant that I think could cause a market swing to a buyer or borrower's favor, I'll lock it.
Yeah, and that's what I think. A lot of the people that have bought in the last 60 days were probably locked before rates jumped a little bit, maybe during the last 30 days. So you're going to see some of that. Plus, I think there's also fear from buyers that rates may go higher. And I'm not going to wait around and have prices and rates go higher and put me out of what I could afford. So you can only sit on the sideline for so long. And if you need to move, if there's whether it's work, whether it's, bigger home, smaller home, divorce, whatever, you can only hold off for so long. And the last 6-7 months of last year, people held off, and we saw that. And I think at some point now, you get into this time of year, people are just going, okay, this is what it is. Prices have stabilized. They're going to start climbing back up, and we need to move.
Which, excellent point. I mean, if people are waiting for the market to bottom out, it looks, we can't predict anything, but the way it looks, that happened at the end of December, early January, as far as pricing goes.
Yep.
This video is brought to you by Klaus Team Real Estate Solutions. The Klaus Team is different. With the Klaus Team, you have someone on your side. Where you live and make memories is important. We have more unique strategies than anyone else to help you accomplish what matters most to you. We can help you with traditional real estate as well as other options such as our lease purchase programs. We can help you buy first then sell, and we can bring you instant offers. We're here to help our neighbors achieve the American dream and help them build wealth through home ownership. For more info or to start your home search, visit us online at klausteam.com.
Yeah,
So let's talk about market balance.
Yep.
Okay.
Are we in a buyer's market, seller's market, balanced?
Overall, we're in a seller's market. We have 2.5 months supply, which is down a month. We had 3.5 months supply last month. And that means basically if you put a pause on new homes coming to the market or homes coming active, if you just paused it today, it would take 2.5 months to clean out the inventory, which anything less than 3 is a strong seller's market. And so the fact that we're back down in that number range and it's going down, it was 2.7 last week. And so it's 2.5 this week. So again, supply and demand drives everything. Builders have pulled back. They're not building. They pulled a lot of their projects from the summer that they were planning to start. And so, again, going back to what we've said since COVID hit, we do not have enough housing for people, and prices cannot continue to decline if that's the case.
Absolutely.
And we've only got 3 cities in the valley that are still even in a buyer's market.
Yep.
But
they're coming strong out of it. Queen Creek's almost there. Maricopa's getting close. I mean, those are the outliers that were still Paradise. Well, luxury is in a different story, but no. And I think that the majority of the valley is in what would be considered a seller's market right now. And I know it's hard for a lot of people to believe coming out what we came out of, but the fact that we were at 21,000 active homes in October and we're at 14 something now. It just tells you that that's a supply and demand thing. We don't have enough homes, so that's what causes prices to go up. And we've already seen it start to happen.
But we want to let people know it's not a seller's market like we've seen in the past.
No. Well, it's not like
it's not the frenzy.
Yeah, I mean, 14,000 homes on the market is different than 4,000.
Yeah.
I mean, in April and March, we had 4,000. So, I mean, of course, that's going to always play into it. But, it's encouraging to see the number of homes under contract back up over 9,000. It had been down to 6,000, 5,000. Sales per month are going up over 7 now. They had been down at 4,500. So I still believe, and even Steve and I have talked about this, that the second and third quarter is where we're going to see the majority of the equity gain this year. Yep. And I do believe that. I do believe we're going to have positive equity. It could be 3 to 6% year over year, but it's going to be positive. So waiting is not going to be in your favor just because we're not going backwards.
No, and I absolutely agree with you. I mean, we're heading into that type of marketplace, and as you share those numbers with me and the rest of the team, is supply and demand is the age-old economic. It drives everything. And
this isn't a luxury. It's not a car.
No.
Or a vacation home, right? It's not like those are what people pull back on. But you need a roof over your head, right?
Sure.
And COVID changed a lot of my mindset of renting because of the uncertainty now. And so now more and more people are going, I'd rather own my home with a fixed mortgage and have some stability rather than continuing to bounce around and hope my landlord's paying his mortgage and can afford it and not deciding to sell in 6 months.
Absolutely.
And we'll be talking about that in a couple weeks, Steve.
Yeah. Yes, we will.
Yep.
Yeah. I mean, so hopefully the Fed sees that it's time to start pulling back a little bit on some of these hawkish policies that they've implemented over the last several months. I mean, that's my hope, because if we can get back to, kind of put all this in the rearview mirror, February, the beginning of March, January was great.
Yeah.
I don't know what happened when we turned the calendar in February, but if they can start pulling back a little bit, kind of start looking through the front window instead of the rearview mirror, And
trying to make up for the mistake of not starting sooner by going too far and too hard, and that's the issue. Would you say that the 10-year Treasury yield is a good gauge of mortgage rates?
It's a good indicator of the possible direction, yes.
Okay.
And again, I
tread
water on that.
The higher the 10-year yield, the higher the mortgage rate?
Yes. Well, as typically, if you're going to see the 10-year Treasury goes up, the direction of the 10-year Treasury usually will tell you the direction of mortgages it's a pretty good indicator because, again, it's a long-term Treasury.
Right.
Most mortgage-backed securities are going to be at least a 10-year fixed, if not 15, 20, 30-year fixed security. So that's why the 10-year is a good indicator.
Yep.
And, I mean, they're so detached right now, it's tough to say. But, again, just directionally, people are like, oh, well, because, again, people hear that and they go, oh, well, the 10-year Treasury today is at 3.64%. Why are rates at...
Yeah, it's
totally different. It's just the direction solely.
Because I always pay attention to that in the morning, if it's over 4 or under 4, if it's going up or down, because then I know I'm going to get an email later from you about rates.
Under 4... Well, under 4 on the 10-year Treasury, again, just a few weeks ago, that was a peak, a mark that some economists had said, okay, we need to hit 4% or greater on the 10-year Treasury to see things start scaling back. And again, meaning long-term fixed rates for mortgages and lending. So, and we did that. Hopefully, we've pulled back all the way back to 3.5%, and now back up to the 3.6, 3.7%, which is fine.
Yeah,
let's stay there and move down from here.
Absolutely.
But just to go back real quick on the rate lock, because again, when periods of volatility, I tell people, I'm going to lock you now. They're like, well, shouldn't we wait? See what the market does. The thing is that when you're in a volatile period, which I think that we're going to be at least until maybe the middle of May. I really think that's a target date for me and those that I follow and listen and talk to. But again, interest rates, mortgage rates specifically, will go up faster than they come down.
Yes.
So if there's a volatile, so again, if you can lock in today at 6.75%, take it, because the likelihood that it's going to drop to 6.25 again by the time your 30-day escrow closes is highly unlikely.
It's more likely it would go
more
up
likely
than
it's
down.
going to go up to 7 in that period. Again, just when you're talking about periods of volatility. So again, just don't get greedy.
Yeah.
Take it and just look ahead and say, you know what, I'm going to have an opportunity to refinance in the future.
Yeah.
So, Steve, if people want to investigate and see what opportunities they have in financing a home purchase, how do they get a hold of you?
Give me a call, 480-215-5590, or shoot me an email at steve.farrington@unityhomeloans.com.
And if you want to get in touch with Kraig or anybody on the Klaus team, you could reach out to us at 480-354-7344. And Kraig, what's your email address?
Mine is just my first name, Kraig, with a K, Kraig, at klausteam.com, KLAUS team.com. Yeah, I'd love to talk to you. Love to just even answer questions about the market and what we see in that. No hassle, no obligation. Just it's not hard to get me to talk about real estate.
Yeah, absolutely. And if people want to get a real clear picture of their home value, some of the just value algorithms and things out on the internet are a little off.
Yep.
Even the ones that, we'll send out stuff and, we can fine tune that and give people a clear picture.
Absolutely.
Yeah. I tell people that all the time too. Even if you just give me a quick call or an email, just a 15-minute conversation and maybe about 4 or 5 questions, I can give you an idea of how much home you could afford based off the numbers you give me. I don't have to pull your credit. You don't need to do an application. We can just have a quick 10, 15-minute conversation, and I can give you at least a clear picture. And then if you do want to buy a home, give you that plan to move forward, whether it's a 60-day plan or a 6-month plan. We'll make it work for you.
Absolutely.
Well, thanks, guys. We'll see you next
time.
Thanks, Scott.
Thanks for spending time with us this week at State 48 Homeowner, the ins and outs of owning an Arizona home. You can connect with us for more information, submit topics you'd like us to discuss further, and you can see relevant videos, give us feedback, answer your real estate questions, and more at state48homeowner.com.